We're going to cover the history of bonds, pricing of bonds, the risks associated with bonds. Are they a good investment? Should they belong in your portfolio? So, bonds, well, let's start with what they are. So, if you own a stock, it is a fractional ownership in a company. If you own a bond, it is debt of a company. And the way it works is, let's hypothetically say that you loan $1,000 to your favorite Fortune 500 company. In return, for 10 years, they'll promise to, at 10 years, they'll return your principal 100%, and they'll provide you with semi-annual interest payments, referred to as coupon payments. So combined together with the principal return plus the coupon payment, that's your source of income. And that's how we value the bonds. So from a historical perspective, there were bonds that were referred to as bearer bonds. So the person that owned it would actually have a physical coupon, a physical certificate, and they could take that certificate into the bank and then take and clip off one of the coupons. And that's the term bearer bond. Whoever bared the bond was able to earn the coupon. Nowadays, it's all digital, and you're very unlikely to see a certificate of a bond anymore. It's just not done that much. Now bonds are a great holding in your portfolio, and the reason why is because they offset some of the volatility of equities. All right, so you purchase bonds generally through a mutual fund or an ETF, or you can buy the individual bonds itself. But if you buy the individual bonds, you're competing against iShares and BlackRock and Vanguard that are buying on a huge scale. So it's difficult to get highest quality at a great price. So most people are own bonds through mutual funds or ETFs. And they're getting very cost effective now to own. There's some ETFs where it's 10 basis points to own mutual funds. It's very inexpensive. And the benefit of owning it through a mutual fund, instead of having a single bond, say of your local county toll roads, you could have 500 across the country. So that distributes your risk across the country and reduces the risk associated with that. So, which brings up a question, what are the risks of owning a bond? Well, the risks are primarily twofold. One is credit risk. Two is default risk. So if interest rates rise and fall, and you don't keep the bond to maturity, that means you have to sell it before it matures, that bond is not going to be worth, say you paid $1,000 for it, and interest rates rise, it's a 3% bond with a 10-year term, and interest rates rise, that bond's going to have a different price. If interest rates fall, the bond is also going to have a different price. It's referred to as par. Par's $1,000. It's above par, beneath par, right? Interest rate risk, credit risk. So some firms go out of business. In recent history, there's been several Fortune 500 companies that have seriously went under hard times, and their bonds have decreased in value. The owners were forced to take a haircut, or maybe they became worthless. So that is another reason to distribute your ownership across a portfolio of bonds so you reduce that risk. But credit rate risk, interest rate risk, those are two of the primaries. Does it belong in your portfolio? Great, it sure does. They're a great offset to equities. It's a good investment. In some cases, it depends upon individual needs and requirements and objectives, but it's a great balancer for equities. The question is what ratio should you put in your portfolio? And that's a very difficult question. And as interest rates rise and fall and inflation changes, it becomes a relatively complex analysis for bonds and the pricing of bonds and should you own bonds and what duration of the bonds. Anyway, those are terms we will cover in additional videos about the details of some of the bonds. Anyway, so this is an overview of the history of bonds, what bonds are, the pricing of bonds and bond risks, and should you own a bond in your portfolio. So in summary, thank you for watching. I appreciate it. Thank you.